Welcome to SCN Corporate Connect. I'm Greg Greenberg, reporting live from the Gaining the Edge conference in New York. And today I'm here with Marcus Storr. He is the head of hedge funds at FERI Trust. Welcome, Marcus.
Thank you for having me.
Well, FERI Trust is one of the largest asset managers in Germany, and you have a lot of that money dedicated to alternatives, to hedge funds. How much?
We have roughly 31 billion in total of assets under management, of which we roughly have between 15 and 20% to alternatives, defined as hedge funds, private equity, infrastructure, real estate, anything which is yielding beyond the non-yielding assets in German fixed income. As we know, German yields are negative. So this is what we combine as alternative investments.
And which strategies, macro, long, short, whatever, are doing the best right now in the current market environment?
I mean, within the hedge fund space, obviously everything which is kind of benefiting from the yield compression, let it be distressed, to some extent activist, but also merger arbitrage is performing quite nicely on top of long-short equity. But long-short equity is obviously driven by equity markets booming. On the other hand, global macro CTAs are a bit underneath the bus still, so it's hard for them to perform nicely. It might be the low volatility which is out there as one of the reasons, but global macro is a strategy which has been a bit subdued for certain reasons, and what we remain very focused on is on liquidity with regards to pretty liquid hedge fund strategies.
And can you talk about the attitude towards hedge funds in Europe right now? Because in America, they're under a lot of pressure because people are watching what's happening in the indexes and they're saying, I just want to put my money in the S&P into an index fund. Why do I need a hedge fund manager?
Yeah, that's a typical quote. Hedge funds have underperformed the S&P again. Germany, I mean, keep in mind it's very conservative, so hedge fund in the first place is not the first choice to invest in. It has quite a substantial dynamic over the last 3-4 years, but you're absolutely right. In Germany, people talk about fees a lot, so fee pressure is the name of the game, and this is across the board. At the same time, and this is more or less a complaint, the hedge fund industry is running too much money. And if you run too much money, you, as a function of math, become the index because you have to go into the large cap. And once you are the index, you can't outperform it.
Well, you're not managing the money. You are finding managers to do that.
Correct.
So how do you find the best managers at the right prices?
Correct. We're the largest hedge fund team in Germany, the largest hedge fund selection team in Germany. So we have a very strict due diligence process. It's very Germanic, so you go through it again and again and again. And at the end of the day, we're currently invested in 41 managers. Keep in mind there are 10,000 managers out there. We have 4,500 in our own database, hence analyzed. It's not rocket science, but it's hard. You have to focus and you have to stick to your process.
And how do you eliminate a manager? Because a lot of times you'll have a manager historically has a great track record and he's just in a tough area of the market. Do you push him out or do you stick with him because you know that eventually that style will win out?
Good question. Main reason over the last 2 years why we redeemed managers is because they breached their capacity limit. They come up, they tell you they want to run $1 billion, and then 2 years later they come up with a nice story why they can run $2 billion. If you've done an analysis of their strategy, you disagree, and that's when you redeem. And we've done that with managers being up 25%, and they look at us like, why the hell do you do this? So from that point of view, this is one of the reasons why we redeem nowadays. The normal knockout functions are change of administrator, change of corporate setup, one of the key traders, key PMs leaving, so anything which shakes up the strategy or the manager. Bad performance in itself is not a must to redeem because you have an assumption of one manager could lose. And
then finally, hedge funds are under pressure, as we just mentioned. You know, where do you see returns coming? I guess we can look ahead towards next year, 2018. You know, what are you telling investors in terms of returns?
Yeah. Let me tell you the way we structure the portfolios. We stick to the very liquid end of the hedge fund space. Merger arb, CTAs, equity long short, global macro, anything which is in the most liquid securities out there. Not knowing when the market will finally bubble up and blow up, but to some extent there's a risk that this will happen. So at that point in time, you don't want to stick in illiquid stuff, certainly not in major long-dated distressed bonds or something like that. So keep it liquid. You have to be invested, in particular in Germany. If you're not invested, you have cash investments which are yielding negative. So we're keeping to the very liquid part of the hedge fund industry.
Well, thanks a lot, Marcus.
Pleasure.
And thank you for watching SCN Corporate Connect from the Agecroft Partners Gaining the Edge conference here in New York. I'm Greg Greenberg.